Hey there, lots of people hate taxes, and honestly it seems pretty unfair when you make a small amount of money and still need to pay a lot of taxes, while some rich dudes publicly say they don't pay any taxes. Some rich dudes like Robert Kiyosaki and Donald Trump have openly talked about how they avoid paying taxes. And you might be wondering, how can they publicly talk about paying less taxes? Maybe even less than you, or not paying at all. While we know that paying no taxes is illegal, why doesn't the government do anything to make them pay more taxes? And you might have heard about some people or companies being arrested for not paying taxes, so what's the difference between those people and these rich dudes who publicly say they don't pay any taxes? Well, rich people have smart ways to pay less or even no taxes at all. There are two main ways to avoid paying taxes: tax evasion and tax avoidance. Tax evasion is illegal, period. This is when people deliberately hide income or lie to the government to avoid paying taxes they legally owe. When people get arrested for not paying taxes, this is usually what they did. So, this is actually the most common form of tax evasion. Basically, people just don't report all the money they make during the year. For example, small business owners might not report cash payments, and freelancers might, hide some of their client payments, and of course drug dealers obviously don't report their illegal income, but the IRS has ways to catch this kind of thing. They match your tax return with forms that companies send them about payments made to you. So if you got paid $50,000 but you only reported $30,000, they'll notice. They also use algorithms to spot patterns that don't make sense, like if someone claims they made very little money but they're spending a lot. Some people try to hide money in secret bank accounts, usually in other countries. They might open accounts in Switzerland, the Cayman Islands, or, other places known for banking secrecy. The idea is that if the government can't find the money, they can't tax it. Honestly, this used to work better in the past, but now there are international agreements that require banks to report account information to tax authorities. The Foreign Account Tax Compliance Act makes it much harder for Americans to hide money overseas. This is when people claim expenses that don't exist or, inflate legitimate expenses. Someone might claim they spent $10,000 on business meals when they actually spent $2,000, or they might claim personal expenses as business expenses, like saying their vacation was a business trip. The IRS looks for red flags here too. If you're claiming way more deductions than people in similar situations, or if your claimed expenses seem unrealistic for your income level, you might get audited. Part 4. Dangers of tax evasion. Tax evasion can land you in prison. Tax fraud is a felony that can result in up to 5 years in jail per count, plus massive fines. Al Capone, the famous gangster, wasn't brought down by his criminal activities. He was convicted of tax evasion. The IRS has powerful collection tools. They can garnish your wages, seize your bank accounts, put liens on your property, and even take your house. They charge penalties and interest that can make your tax debt grow much larger than what you originally owed. Even if you don't go to jail, tax evasion destroys your financial life. You'll have trouble getting loans, your credit score will tank, and you'll spend years dealing with the consequences. Section 2. Tax avoidance. Tax avoidance is completely legal. This is using the tax code exactly as it was written to pay the minimum amount of taxes required by law. Rich people and corporations hire teams of accountants and lawyers to find every legal way to reduce their tax bills. Part 1. Controlled foreign corporation. This is a popular strategy for multinational companies. They set up subsidiaries in countries with very low tax rates like Ireland or Singapore. Then they structure their business so that most of their profits are earned by these foreign subsidiaries instead of in high-tax countries like the United States. Apple is famous for this strategy. They route their international sales through Irish subsidiaries that pay very low tax rates. The profits stay overseas and aren't taxed by the United States until they're brought back to America. This is called profit shifting, and it's completely legal. Tech companies are especially good at this because their products are mostly intellectual property, like software and patents. It's easy to say that the value was created in a low-tax country, even if the actual work was done elsewhere. When companies have operations in multiple countries, they have to decide how to price transactions between their own subsidiaries. This is called transfer pricing, and, well, it can be used to move profits to low-tax jurisdictions. For example, a company might have its United States subsidiary pay high licensing fees to use patents owned by its Irish subsidiary. This reduces profits in the high-tax United States and increases profits in low-tax Ireland. As long as the prices are within reasonable market ranges, this is legal. The key is having good documentation to show that the prices are fair. Companies actually spend millions on transfer pricing studies to prove their internal transactions are legitimate. Part 3. Using dividends. So, rich individuals often structure their income to take advantage of lower tax rates on dividends and capital gains. Instead of taking high salaries that get taxed as ordinary income, they might, take smaller salaries and larger dividend payments. Warren Buffett famously pays a lower effective tax rate than his secretary because, most of his income comes from dividends and capital gains, which are taxed at lower rates than wages. This isn't tax evasion, it's actually the tax code working exactly as Congress wrote it. Private equity managers use something called carried interest, which lets them treat their compensation as capital gains instead of ordinary income. This can, in some cases, cut their tax rate in half compared to if it were treated as salary. Part 4. Advantages of tax avoidance. The biggest advantage is pretty obvious. You keep more of your money. But there are other benefits too. Tax avoidance strategies often involve legitimate business planning that can actually make companies more efficient and competitive. International tax planning, for example, can help companies expand globally and compete with foreign rivals. Charitable giving strategies let wealthy people support causes they care about while, at the same time, reducing their tax bills. Retirement planning strategies help people save more for their future. Tax avoidance also drives economic activity. The mortgage interest deduction encourages home ownership. Depreciation rules encourage business investment. And, research and development credits encourage innovation. The difference comes down to intent and legality. Tax evasion involves lying, hiding, or breaking the law. Tax avoidance, on the other hand, involves using legal strategies that Congress specifically put into the tax code. Tax evasion is like speeding. You're breaking a clear rule and just hoping you don't get caught. Tax avoidance is like taking the fastest legal route on your GPS. You're following all the rules but finding the most efficient path. The government actually wants people to use many tax avoidance strategies. Retirement account contributions, charitable donations, and business investments all get tax benefits because Congress wants to encourage these activities. Rich people can afford teams of tax professionals to find every legal deduction and strategy. Poor and middle-class people usually can't afford this level of tax planning, which is why they often end up paying higher effective tax rates despite having lower incomes. The tax code is incredibly complex, over 70,000 pages long. Rich people use this complexity to their advantage by finding obscure but legal strategies that, honestly, most people don't even know about. Many people confuse tax avoidance with tax deferral, but they're actually different strategies with different outcomes. Tax avoidance means you never pay the tax at all. For example, if you donate $10,000 to charity and deduct it from your income, you've permanently avoided paying tax on that $10,000. It's just gone forever from a tax perspective. Tax deferral means you're postponing the tax payment to a future date. Traditional 401k contributions are tax deferred. You don't pay tax now, but you'll pay it when you withdraw the money in retirement. So, you're not avoiding the tax, just delaying it. Rich people use both strategies. They might defer current income to years when they expect to be in lower tax brackets. They might also permanently avoid taxes through strategies like charitable remainder trusts or stepping up the basis of inherited assets. The key difference is timing. Deferral is about when you pay the tax. Avoidance is about whether you pay it at all. Some strategies even combine both approaches. A Roth IRA conversion, for instance, involves paying tax now on deferred income, but then all future growth is tax-free forever. You're deferring some tax and avoiding other tax in the same transaction. Understanding this difference is crucial because it really affects long-term financial planning. A strategy that just defers tax might not be as valuable as one that permanently avoids it, depending on your future tax situation.